Right. Well, thank you everyone for joining us today for our FCA educational series. Today is Exit Readiness and Management Transfer Strategy. And it's brought to you in collaboration with Roger A. Feldman, CPFA, Financial Advisor with UBS Financial Services. And if you could please join me in welcoming Brian Umensky, Managing Director with Ambrose Advisors. Brian works closely with business owners on succession planning, ownership transition strategies, and maximizing long-term business value. He has also been a valued contributor to our FCA International Signatory magazine, which we have right here. And there's an article that, Brian, we have from you. So Brian has been a value contributor to our FCA International Signatory magazine, sharing insights and guidance on succession planning and exit readiness for contractors and business owners across the industry. Also, we have joining us, I think very soon, Christopher K. Hicks, Managing Director, Wealth Management, Financial Advisor, and Senior Portfolio Manager with Anchor Wealth Management. Chris works with business owners and individuals on financial planning, wealth management, and long-term investment strategies, helping clients prepare for both business transition and personal financial success. Before we begin, Brian, I just want to let our attendees know that if they have any questions, you can type them right into the chat, and then Brian and Chris will be able to answer them for you. With that said, Brian and Christopher, hopefully Chris will be joining us soon. We appreciate you being with us today for this very informative presentation. And Brian, I'll turn it over to you now if you want to get started.
Yeah, no, very good. And yeah, while we're waiting for Roger and Christopher to get back, maybe I'll just give a brief intro of myself and what we do as a firm. So I work with Ambrose Advisors. We're a lower middle market investment banking firm, and so what that means is we work with business owners on executing mergers and acquisition transactions, and typically our focus is with companies that we classify as lower middle market, and that typically means businesses, at the smaller end, somewhere around 10 million of value, all the way up to 250 to 300 million of enterprise value. And one of our principal jobs is an educator, and that's to educate business owners on transaction alternatives and how to prepare them, how to prepare themselves and the business, for a transaction. And so 90+% of what we do is help business owners, sell their business, and that can take the form of selling to a third party, or what's a very common transaction for business owners, in the contractor space, is selling their business to an employee stock ownership plan. And so we can touch on the differences in those types of transactions. But regardless of the transaction that's pursued, there are certain things that we believe that you can be doing well in advance of a transaction to prepare yourself, for an eventual sale. And so, as I'd mentioned, 90+% of what we do is advising business owners on selling their business, but we also, um, advise business owners on raising capital and going out and acquiring other companies as well. And so, my experience is working with business owners on executing those transactions, and happy to talk with everybody today. With that, I'm going to turn it over to Roger for a brief introduction.
Good afternoon, everybody. My name is Roger Feldman. I'm with UBS Financial Services based in Baltimore, Maryland. And thank you to the FCA International for inviting us to be here. We originally spoke to the FCA when you were in Clearwater, and it was a great trip, and thanks so much for including us there. We gave a presentation then on exit execution. And our platform, Exit Readiness and Execution, Tony said that, and congratulations to Tony with his daughter and the win, the Professional Women's Hockey League yesterday. That's phenomenal. But so in our conversations with Tony, he asked us to come back and say, you know what, can you share some more information with our guys? And here's some of our thinking. For a business owner, particularly a contractor, really about 80% of your net worth is tied up in your business, right? And then for contractors, our UBS research and working alongside the Exit Planning Institute, we've learned that most business owners anticipate the sale of their business, the transition, right, where they monetize and ultimately, ownership, management change, et cetera. They anticipate the proceeds from the sale of their business to fund their retirement, right? So how do you prepare for the most important transaction of your life? That's our thinking, and we firmly believe that your exit plan needs to be a part of your business plan. So how do you do that? We have found that a lot of times business owners are so busy working in their business that they don't take time to work on their business. So what we hope to accomplish today in about 25, 30 minutes or so, and certainly longer with questions, is we like to have a conversation with you that at the end of today you have a framework for your thinking, and we anticipate really, or we share the concept with people that ideally you would start the planning for the sale of your business 3, 4, 5 years in advance. So we'll talk about this from two perspectives. One will be from you, the business owner, for yourself, and then the other perspective will be from the perspective of your business itself. So to start the conversation, I'd like to do a couple things. I'd like to introduce my partner, Chris Hicks, who just logged on. We had a little bit of technical difficulties here, but Chris and I are both at UBS Financial Services based in Baltimore, Maryland. And then our partner, Brian Humaneski from Ambrose Partners, based in Dallas, Texas. So Chris will start our conversation with what we refer to as the wealth gap, right? It's really important that you have an understanding of what your personal needs are as you start this process. So with all that being said, Chris, can I hand it over to you, please?
Certainly. Thanks, Roger, and thanks for having us, everyone. As Roger said, when we look at this event, we want to do some planning in advance. We truly believe that the plan really will drive the exit strategy and kind of everything moving forward. So a couple of years out before any possible liquidity event or sale or transition, think 2 to 5 years out, we really want to get the house in order. And what do we mean by that? We want to look at a few different facets of the overall business. We want to look at professional, personal, and financial, right? And to simplify that, professional is kind of industry trends, get an idea of what's going on in your world. Personal, we want to dive into what are your goals, right? What's that gap? If we sell the business, what do we need to live on? Can we successfully achieve retirement and all the goals that you may have kind of in the next stage? And how does that look? And then also the financial side of it, further down the road, wealth transfer, legacy, all those sorts of things. And then as we get closer to the sale, about a year out, we've gone through the planning. We've looked at all the different aspects going into it. We really want to strive on don't get distracted by all the noise. Okay. Markets change, wars happen, things of that nature, right? We believe in the plan. The plan will drive the success of everything. It's adaptive, so it's not locked in stone. We will adjust as need be. And this is a process. So it's not something that, a couple weeks or months or a year before a sale you want to start looking at. The more time we have to discuss that, the better the plan and the outcome will be. To that, Roger, I don't know if you want me to go into more, or we'll come back to.
Well, so Chris, thank you. I think what we'll do is we'll now turn it over to Brian just to touch on a couple of different types of exits, just at 30,000 feet, and then we'll dig into considerations when preparing for a sale. And then Chris, we'll come back to you with the 3 L's to wrap everything up. So Brian, just a couple things. Let me see. There we go. Okay. So guys, as I mentioned, right, 58% of business owners have no business appraisal, right? They're lacking a proposal. 48% have no formal exit strategy in place. 41% have really no idea what they're going to do in retirement, We maintain that people spend more time planning their vacations than they do their retirement. And then actually, Brian, if you'll just touch on the internal and external, and then we'll move to things to consider as you start your plan, please.
Thank you, Roger. So at Ambrose Advisors, we're an investment banking firm that, really doesn't have a preference in terms of what type of transaction, a business owner is looking to achieve. We feel like we've got capabilities to help with, with either selling a business outright to a third party, which oftentimes takes the form of selling to either a strategic competitor, or potentially a financial buyer, which could be a private equity firm or a family office. Are terms that you're hearing probably pretty commonly now. But in addition to that, a very common structure, especially for contractor type businesses, is selling your business to an employee stock ownership plan. And each transaction has its pluses and minuses. For instance, when you're selling your business to an ESOP or an employee stock ownership plan, there's certainly a great benefit that you're providing to your employees. You're continuing the longevity of the business. You're keeping it kind of in the same hands that it is today. So it's not like you're having a third party come in and change up operations or the way things that are managed, currently at the business. So, for business owners that are looking to maintain kind of the status quo in terms of, operating the business, then the ESOP can be a very, very attractive alternative. There's also really great tax benefits associated with selling your stock to an ESOP. You have the ability to defer your capital gains taxes on the sale and some really good corporate tax benefits. And then when it comes to an outright sale, again, that can take many forms or fashions. And I think, as Chris had mentioned, um, you want to be thinking about that well in advance. And there are things that you can do even prior to entertaining any transactions to set the business up to maximize your after-tax proceeds. And what I mean by that is there's, some really powerful sections of the tax code, like the 1202 exemption, for instance, that some businesses may be able to capture. And that exemption basically, in certain situations, allows business owners to sell their stock in a business, and be exempt from capital gains taxes on a portion of that sale. And the reason that it's important to think about that well in advance is because there's certain ways that the company needs to be organized in order to capture that. For instance, to capture that benefit, you have to be a C corporation, right? When you're thinking about incorporating, even at the onset of starting the business, well, that might be something that you want to consider if you're thinking about an eventual exit. But regardless, if you're a couple of years away from an exit, there are still things that you can be doing to maybe position yourself to be able to take advantage of that benefit and other potential benefits. And so I think the punchline is there's a lot of different alternatives out there. There are pluses and minuses to each approach, and consulting with an advisor is the best way that you're going to be able to kind of capture and summarize, all the potential benefits, of each particular structure. And so, as educators, that's what we enjoy doing. I know that's what Chris and Roger enjoy doing with business owners leading up to a sale. And so I think there's, a lot of value in consulting with folks like us that, that give that advice out really essentially for free, right? Because for us, it's about educating business owners, and if we do that properly, then we know that that down the road there might be opportunities.
Brian, that's terrific. Thank you. So let's dig in a little bit further, right? So now we've talked briefly about your plan, what you need. Uh, we reviewed some of your options for your exit strategies, but now let's dig in. Like, is your company diligence ready, or are you still thinking that perhaps just an accountant will suffice for everything that you're doing, and maybe it's time to think about working with a CPA instead? So Brian, would you continue the scenario? We've decided we've started our plan. We're going to next we'll talk about building our team. But what are some of the things that you need to do to get your house in order?
Yeah, no, very good point, Roger. And I think there's a lot of things that that you could be doing in advance of even contemplating a transaction. And what we see all the time is whether we're running an ESOP transaction or a third party sale process where we're going out and talking to multiple buyers is, there are certain things that that you see pretty consistently that that buyers have concerns with. And in particular with project related businesses, I think it starts with the financial reporting and accounting. And I can't really emphasize this enough. A lot of business owners, when they start thinking about a potential sale, they might make an assumption, well, I need to have audited financial statements or reviewed financial statements. And while those might be good, and they might add value to the process, really what a third party buyer is going to do once they get to the point where they've executed an LOI, is they're going to bring in a third party accounting firm to basically come in and recreate your financial statements. So they're going to audit what your accountants have been doing. But more importantly, they're going to take their own view on looking at your monthly income statement and balance sheet and statement of cash flows going back the last call it the last 36 months. And they're going to want to understand the trends that are in the business, any kind of major deviations month over month, which there can be a lot in project-based businesses. And so I think one of the most important things that business owners can be doing, regardless of the size, of the operation, is having good quality, consistent financial reporting. And what does that mean? Well, that means preparing monthly financial statements at a minimum, reconciling those financial statements to accounts, reconciling bank accounts, um, making sure that WIP schedules reconcile to the financial statements. And one of the things that, we're running a process right now for a business that's a project-based business, and just received a letter of intent for that business. And one of the things that, and I've been doing this, about 25 years, advising business owners in this capacity is, one of the things that, that we saw in this letter of intent that we haven't seen before is a concept of what they call the look back escrow, where they want to make sure that the estimates that are being used for project accounting purposes, so the estimates that are being used in the WIP schedule, um, that those are going to hold up by the end of the life of the project, because the transaction is going to occur mid-project in a lot of cases for a lot of the work that's being done. And so I think making sure that you're using good, reasonable estimates in that WIP schedule is really important, because the concept that they've employed here is basically saying, okay, well, if we go back and we look back at these projects, after they've been completed, are the margin estimates at completion consistent with what's been in the recorded in the WIP schedule? And if not, then there's an escrow in place where they could draw down funds. And so I think, I say that just to highlight the importance of having good quality financial reporting that's reconciled with good estimates. And again, having reviewed statements, having audited statements, those are really nice, those are really nice additions. But I think, at at the baseline level, I think having just the ability to generate good monthly financial statements is a really good starting point.
So Brian, to follow with that, as you know, we've spoken with many signatory contractor associations. The 5 factors for maximizing business value, as Kip just touched on this a little bit: high
Yeah.
quality financial reporting, right? We talked about that. Recurring revenue streams, if you'll opine here just a second, management depth, reduce customer concentration, and growth opportunities. Can you share a little bit along those other points?
Yeah, yeah. No, and I think so when we kind of tier some of those out, I'm going to put high quality financial reporting at the top. Beyond that, I think having depth of management is critical to getting a successful outcome, whether it again be a third party sale or an ESOP transaction. In an ESOP transaction, the trustee that is essentially representing the buy side in the deal wants to make sure that the company that that's being acquired, has a team and has a bench that's capable of running the business going forward. Third party buyers look at it the same way. Now, you might have strategic buyers that that can fill some of the gaps in a management team, but I think when you're going to market, you need to be able to position the business that there's something more than just the owner. If it's a situation where it's either a single owner or just a couple of owners. Um, in addition to that, I think, it can be challenging depending on the business, right? Concentration is certainly an area that gets a lot of focus. Having recurring revenue from clients, whether or not those clients have contracts where they're providing recurring revenue, or it's just recurring project-based revenue. Well, that's still recurring revenue, right? Those are relationships that are generating a consistent base of business. And I think being able to demonstrate that, is really important because that's really, the biggest intangible, aside from the people that third party buyers are acquiring in a transaction. And then lastly, I think growth opportunities. I think, and each business is going to be a little bit different in terms of what those opportunities are. But I think when you're out there talking to folks and talking to, potentially third party buyers, I think you need to be able um, to show that there are opportunities beyond what the base business is doing today and be able to articulate those, even if you're not, generating revenue and profits from those opportunities today, showing that, you have a line of sight to, additional opportunities is really what third parties want to see.
So Brian, so how do we handle when the patriarch is really, a lot of times came from the union itself, right? And came over to the management side, became a contractor, and 40 years later has a great book of business. Um, but the patriarch is the key point of contact for many service clients, right? How do we address that? Or in the same token, we may be a company that has two or three phenomenal clients, and they're 80% of our revenue. How do we address those things as we start this prepare for sale journey?
Yeah, yeah, and I think, related to the first point is I think you really want to spread out, those customer relationships within the organization. Right now, obviously, a lot of times you have situations where the business owner, either started the business or has been involved in the business a long time, and naturally has developed and grown those relationships. But the most successful outcomes are those where the relationship with the customer, extends to many levels within the organization. It creates a greater stickiness of that relationship, and alleviates some of the risks that we talked about, which is, having kind of that single person be the primary point of contact for a customer. And so that's risk for a potential buyer. And so I think what you want to do early on is make sure that those relationships, that there's multiple touch points within the organization to those customers, so that when you're talking with potential buyers, you could say, look, yeah, I mean, our organization is structured in a way where customers, have the ability to contact, anybody within the organization or these levels of people within the organization.
And then from the governance perspective, do financial buyers, right, the private equity or strategic buyers, competition, uh, in today's competitive environment, do they look for companies that have strong governance or maybe even a board of directors? Or those things that are often taken into consideration?
Yeah, I think they want to see companies that have a good sense of, governance and processes that are in place, and implemented throughout the organization. It speaks to the structure of the business and the professionalism of the business, and I think that is going to make it certainly more attractive, to folks when they're evaluating opportunities.
Gotcha. So I'm going to share my screen for another moment here, and we're going to skip ahead, and just for a second. There we go. Remember, we have you, the business owner, and your needs. We have the company and its needs, and then we have your needs, and retirement for the next 30 years of your life. So we started with Chris and the wealth gap. Um, we're going to focus on build the right team, surround yourself with trusted advisors. So I'm going to ask Brian to pick up on this for a second and then go back to Chris because it all leads back to your initial needs, right? To what's most important to you. So, Brian, can you talk a little bit about who needs to be involved?
Yeah, absolutely. And so I think, when you're in the initial stages of planning for an eventual exit, I think there's a couple of folks that, that you really want to be, having discussions with pretty closely. And I think, we touched on one issue before, which was, if you set up the corporation in a way where you can potentially qualify for some of these really, really great tax benefits that the government offers, you certainly want your legal advisor or counsel involved in helping you evaluate the structure and that decision. Um, and I think even before you get to that point, you know, from a personal standpoint and maybe less so related to the company, you're going to have a personal CPA and a financial advisor. And I think those folks are all critical people to have, um, to kind of have in your pocket and to consult with as you're evaluating these things. As a firm, again, our lead time from, when we start talking with potential clients to ultimately working on a transaction is a long one. And so oftentimes, we get involved many years before a business owner is even contemplating doing something to kind of coach them and help them along, and do things like a sanity check on valuation. We wouldn't recommend if you're just curious what the business is worth. Well, we're not going to recommend that you go out and you go hire an appraisal firm to do that. There are investment banking firms like us that do that work for free. And so I think consulting with investment bankers or advisors that way, can really allow you to kind of hone in on the things that are important in terms of, organizing the business and getting it ready for an eventual sale. When you think about, getting to that point where you've made the decision now to sell the business, well, again, it's going to be the same folks on the personal side, your financial advisor, your CPA that you're really going to lean on to consult with. But then once you get into that, once you get to that point of launching a process, it's really going to be typically an investment banker that's going to advise you through that. Their role is going to be to help you go out and find buyers, but also prepare the materials that you need to be able to go out and speak with buyers. You'll often involve your counsel at that point as well. And that really comprises your team, when you're launching a sale process.
Great. So, okay. So now we're making a lot of progress. We've established what we think we need, right? We've addressed that. We're putting our house in order. We're putting our team in order. So let's do a touch base with Chris now and say, how does this fit into the next 30 years of my life? And then we'll talk about potential buyers to wrap up. But so Chris, can you please talk about what we call here at UBS the three L's?
Sure, sure. So, kind of piggyback on what both Roger and Brian have said, the team is very important, and the team that you put together should all work together, right? It shouldn't be different entities. We're on the financial advisor side and try to piggyback these sorts of transactions. But we all want to work together. We want to work with the CPAs, and we want to work with the legal team and Brian's team to make sure that everything is being done appropriately for you. So earlier we kind of talked about the wealth gap, right? If you sell this business, what do we need to live on? We create this plan, right? So we do all the legwork. The transaction occurs. We're now post sale, right? So now what happens, right? So ideally, what it is we execute that plan that we've set up, and as Roger mentioned, we kind of look at the three L's, which are liquidity, longevity, and legacy. And to kind of break those down, the liquidity bucket is, we want, cash for operating expenses. We want to maintain our lifestyle. That's going to be things, liquid investments, cash, treasury bonds, things of that nature that kind of just keep you moving forward the way that you're used to. And because remember, you've sold this business, so there's no more income coming in. So we want to make sure we're now providing that income and cash flow to maintain lifestyle. Could be travel, entertainment, all those sorts of normal living things that you're used to beforehand. The longevity bucket, is how do we make sure it lasts, right? And the plan has dictated that a little bit, right? We've defined our goals. We know what we need moving forward. We've run models. We've planned on this. The longevity bucket is going to be more, developing a balanced portfolio between stocks and bonds and cash and maybe alternative investments and all sorts of other things that continue that lifestyle into the future. Okay. We look at retirement, healthcare costs, are there vacation homes in the future, right? All those sorts of things on the longevity, because we don't want to run out of money, right? So we want to continue that, make that work for you, and make sure we're achieving those goals that are needed. Legacy is exactly what it sounds like. So, we need to think about, depending on the size of the sale, right? The value that's been created, the wealth that's been created, over 30 years, if we do our job right, we're growing that wealth on top of what the liquidity event created, right? So we want to get creative and have you think about, what do we do when our time is up? Are we charitably inclined? How do we transfer wealth to children or other family members if we want to? And we try to define that, and in the most efficient way, create and set up the solutions to provide that, whether it's through charitable foundations that we create for you, or certain trusts and insurance ideas that will pass that wealth in the most efficient way to whoever you want it to go to, whether it be kids, charity, other entities, or anybody else. Okay. And then over the years, in the 30, 40 years during that process, we continually review and evolve that plan, right? Because times change, things change, surprises happen, and we kind of take you through that.
That's fantastic. Thank you, Chris. So, in the interest of time, I think I'm going to turn to Brian for one last thing. Brian, help us wrap this up from the emotional perspective of the seller, right? So the seller's done all his homework. He's worked with his trusted advisors, and he's working, or he's working his way through the process. But can you talk on like how it affects the seller emotionally, and how can they can be best prepared, and how all your advisors are a source of strength, post transaction? Because eventually everyone will leave their business and someone new will own your company at some point.
Yeah. Yeah. And I think it certainly can be a stressful time, for owners when they're going through this process. And I think the best way to alleviate that stress is to have really good advisors that you're leaning on and to be prepared, right? And so that's why, one of the things that we continue to highlight is doing that early, well in advance of a sale. And so I think, it is an emotional process, whether or not you're looking to sell to a third party. There's all types of considerations there, confidentiality being, one that we see sellers wrestle with quite a bit, because they want to be able to facilitate the process and go out and talk to potential buyers, but they also want to make sure that, that their team, doesn't, it doesn't feel like that they're being left out, or that confidentiality is breached and causes disruption to the business. And so, when you get to that point, I think it's really important that you lean on the experience of your advisors when you're going through this process. A lot of times we see business owners, try and execute these transactions on their own, and that is certainly something that is possible. I just don't know that you get the best outcomes. You're not able to leverage the experience of folks that are out there talking with buyers on a routine basis, that have the experience of performing multiple deals. And so I think it is important to lean on all of your advisors, and their collective experience, to help alleviate some of the emotion that comes with a transaction like this. On the ESOP side, it's confidentiality is still a concern, because you don't want to message to employees that you're doing a transaction like that, and then ultimately not do it. And so typically we see that business owners keep those transactions confidential all the way up until a close. But I think, what you get with an ESOP transaction is more certainty than what you're going to get in a third party sale. There's a built-in buyer there. The methodologies that are used for valuation are all fairly consistent, and you have a buyer that's not necessarily looking to get the best purchase price. They're just making sure that the deal is fair for, for the employees. Whereas in a third party context, you're dealing with a buyer that, their return is dictated by, the purchase price. And to the extent that they can get a lower purchase price, it's going to increase their return.
So, with all this being said, our approach here is it's never too soon to start planning. Your exit plan should be a part of your business plan. You should review it annually. Surround yourselves with trusted advisors. Lean on them. Absolutely lean on them. Be transparent with your family members, right? You're. It was funny. I was at a seminar last week, and someone said, "Well, every owner has his number," and someone yelled from the back of the room, "Yeah, just ask his wife," which is kind of tongue in cheek, but it's a very real thing. So we thank you for your time today. Karen has said that she and Tony will share with everyone that attended our presentation. We are more than happy with Brian to prepare, of course, with an NDA and no obligation whatsoever, a complimentary evaluation. And we encourage you to move forward and kind of, someone said to me recently at a presentation, um, well, what would it look like if you wrote your own obituary? And so I thought, wow, that's really a forward-looking thing. So, think about it. What are you doing for the next chapter of your company? What's that going to look like? So we thank you all for spending time with us today, and we hope we hear from you again sometime soon. Thank you also very much.
Hey, Roger.
And Roger?
We have a few questions here.
Yes, over to you.
Maybe we'll try and address those just real quick before we adjourn. The first one that I see in the chat here is, what are the top 3 contributors that my business should focus on? Is it backlog, annual sales, scope diversity? And I think that, I mean, that's really really a good question. At the end of the day, regardless of the transaction that you pursue, most buyers are going to be focused on a metric called EBITDA, earnings before interest, taxes, depreciation, and amortization. And so all the things that are, that are mentioned up here, or that I just referenced that were in the question, those are all really important to getting to that EBITDA number. But buyers are going to be focused on what is the earnings that you're generating from the sales and the backlog that you've generated. And so I think backlog, annual sales, diversity of both customers, and then also the types of projects that you're working on are all things that will that will help value, right? Greater sales is going to lead to a greater EBITDA, presumably, which is going to certainly improve your value. And then having diversity of scope and customers creates less risk. And if there's less risk in the business, then buyers are typically willing to pay more. And so, a good example is we're working with a contractor now where 90+% of their business is with one particular client that builds locations throughout the country. And it's a great client that they have, and they're doing that work for they're a subcontractor, they're doing that work for multiple general contractors. But the way that a buyer looks at it is that it's concentration with that one particular end user. And what you see is you just see either buyers not elect to pursue the transaction when you've got that level of concentration, or there's a big discount, right? The market multiple that you might get for a business if it was 4.5 times EBITDA then becomes 3.5 times EBITDA. And so I think all of those things are important. Backlog, sales, diversity of projects, and customers. At the end of the day, though, the number that most buyers are going to look at is what's your earnings, right? What are you generating from those sales? And the common metric that's used is earnings before interest, taxes, depreciation, and amortization. The additional question that was here was, what should you be doing 20 years out? Instead of just 3 to 5 years out. Well, I think a lot of it's a lot of the same things, right? It's making sure that the corporation is structured in a way that, you potentially have the ability to capitalize on certain tax benefits, which obviously can change. And so that shouldn't drive, your decision making entirely, but it should be a consideration. But then it's the other things that we talked about, having good, high quality financial reporting, reducing concentration to the extent that you can, building a really deep team to support you. I think I think those are the most important things that you could be doing 5 years out or 20 years out. And so I think if you start 20 years out, I think, build your team so that it's strong, that there's depth and there's a bench there, and make sure that, that you got good people in finance and accounting roles, and that you're getting the reporting that you need to be able to manage the business and present it to other folks. Um, just two other questions here. One was related to, how do you find a third party buyer if you don't currently have a buyer? Well, that's our job, right? That's the job of an investment banker, is to go out and help find that buyer for you when the time is right. And depending on your business, you may have some businesses where, that buyer list is going to look like, all your competitors. So it's going to be largely strategic buyers, right? Or you have some businesses where, there's a lot of financial sponsor activity. And so I think leaning on the experience of an investment banker, I think, is how you're going to get the best results there. And what we do is we consult. We consult with you on, any names that maybe we have missed, to make sure that we've got a good comprehensive list. And then the last question was just, what if the patriarch is still a union card holder? Um, you know, it, Whether or not they're union or non-union, really isn't going to impact, your ability to sell the business, right? I mean, there's a lot of buyers out there that, that are looking to make acquisitions of union businesses, and non-union focused businesses. And so I don't think that would preclude you from doing anything.
Karen,
That's
I
it.
think we've covered everything, Karen, I believe.
Yep, that was all the questions. So thank you very much. And I want to thank you, Brian, and also Roger and Christopher. That was very interesting, even though I'm not even a business owner, but it was very, very interesting. Should any of our participants have any additional questions, feel free to reach out to us here at FCA, and we will direct those questions to either Brian or Christopher or Roger. And we appreciate them very much. Just so you know, our next FCA educational session is Benefits Follow the Member, and that will be held on June 18th. For more details and to register, just go to our website, finishingcontractors.org, and click directly on the word events. And there you'll see all of our upcoming events, and we want you to add those to your calendar. So thank you all very much for joining us today, and we hope to see you at our next session. And thank you again, Brian, Roger, and Christopher. If we have any further questions, we will definitely let you know.
Thank you.
Thanks all.
Excellent. We appreciate it.
Cheers.
Yeah.
Bye-bye.
Thank you. Bye-bye.
Thanks, everybody.